In its annual survey of U.S. wealth management trends, FTSE Russell found that nearly half of all retail investors working with a financial advisor haven't been engaged in a conversation about indexing. At the same time, an overwhelming number of those polled said they wanted to hear more about these types of investment strategies and funds. That raises an important question. Why don't more advisors take a greater interest in educating their clients about how to implement a more systematic and consistent style of investing? To discuss this issue, we're fortunate to have with us today Wes Crill, the head of investment strategists and a vice president at Dimensional Fund Advisors. Hi, Wes. Thanks for taking the time to talk to us about such a perplexing issue.
Yeah. Hey, Murray. Thank you for having me on. Very interesting topic indeed.
Yeah, we've seen a rise in popularity for indexing strategies over the past decade. Why haven't more advisors talked to investors about these types of funds, and why haven't more advisors developed a depth of knowledge sufficient to properly start a conversation about these types of funds and strategies?
I think it's an interesting trend that we are seeing in the data. You're spot on when you mentioned there has been a lot of flows going into index funds. In fact, over the last 5 years, about $1.4 trillion have gone in there. So quite a big number there. Mm-hmm. I think it's an interesting, almost a referendum on the periods that we've gone through recently in the markets, 2022 and even going back to 2020 for sure. These were tumultuous periods. And I think investors don't like to see uncertainty within their investment portfolios during those kind of periods. They like to know what they're going to get. And I think this is where you see the appeal of something that's rules-based, that's systematic. And certainly that makes sense, especially when you compare it to traditional active methods of investing that might have lower levels of diversification, higher costs, and just general uncertainty about what the investment results are going to be in any given period. So I think it makes sense from that standpoint. But there are things for investors to remember. When you look at the flows at $1.4 trillion over the last 5 years, about $1 trillion of that was going into the lowest decile of expense ratio for these. And so it really is a big story in my mind about investors seeking at the lowest costs. And that's where I do think investors need to be careful at the end of the day, because while costs are an important determinant of your investment experience, we do feel that you can go beyond what indexing has to offer by having the appealing aspects of indexing, right? The broad diversification, the relatively low cost, low turnover, but then have flexibility in a daily process so you can add value and avoid some of the unnecessary constraints that might come along with an investment approach that has a very regimented approach to rebalancing.
Yeah, it's interesting because the FTSE Russell survey reported that besides costs and expenses, 3/4 of those surveyed who already were indexing or using index type of funds were thought that their performance was at least as good as, if not better, than actively managed funds. And also, interestingly enough, right next to performance was creating a diversified portfolio as viewed as high in terms of driving long-term performance. So I guess more people are getting it.
Both of those make a ton of sense. I mean, we know just from a longer-term view on the academic evidence that index funds do tend to outperform active funds. In fact, in our fund landscape that we look at every year, we see that over a 10-year period, only about 20% of active equity managers are able to outperform index benchmarks. And I think that is really a tribute to or related to this renewed interest in a passive style of investing. And in the broad diversification, I mean, we know that it's not every stock in the market that delivers the equity premium, right? It's usually a subset of stocks that drive the equity premium in each year. And the more broadly diversified your asset allocation, the more likely you are to be holding those stocks. And then, of course, gives you a built-in risk management tool, right? The more stocks in the portfolio means that you're not as subject to the concerns of individual stocks as you would be if you had a very concentrated portfolio.
Yeah, another interesting point revealed in the FTSE Russell survey was that the study found that only 29% of those surveyed use small cap indexing strategies. And of those polled who do invest small cap equities, 4 in 10 still use actively managed funds, and the rest are mostly trying to pick individual stocks in the small cap category who do use small caps.
Yeah, that's an interesting observation. I mean, I think there's maybe a couple of things that play into that. The first might be an ongoing belief that, okay, well, I believe markets are pricing securities well in the large cap space, but once you get into small caps, that's the Wild West. That's not what we see from the data. The paucity of fund managers that are able to outperform is just as relevant in small caps as it is in large caps. So it suggests that the market does just as effective of a job pricing securities there, which would be counter to the notion of using traditional active methods of investing there. Now, the other side of the coin here is, even if you believe that markets do a good job even in the small cap space, it's inherently costlier there. Trading costs tend to be higher. And so to the extent that you have an inflexible investment approach, so a traditional approach to index investing that might reconstitute or rebalance the portfolio once or a few times a year, that gets more expensive in small caps than large caps. And so you might find that both traditional active and traditional indexing can be less appealing within the small cap space. And that's where we believe having a flexible approach, like we employ here at Dimensional, having a flexible approach to your trading and managing the portfolio continuously throughout the year can be especially beneficial when you get to small caps.
And again, a well-educated, experienced advisor can go a long way towards helping investors reach their goals, correct?
Yeah, absolutely. I mean, again, this sort of comes along with the idea of discipline. And when we talk about stocks that have traditionally offered higher rates of return, like small caps or value stocks or high profitability stocks, you only get those premiums if you're there and you're invested when the premiums are delivered. And absolutely having a trusted financial advisor to kind of help you weather the storm. We all have emotions when it comes to investing, me just like everyone else, but having someone who can instill discipline and keep you in your seat so that when these premiums are delivered, you're there to capture them. That's a big part of really taking advantage of these things that look great on paper.
Okay, well, thank you very much for your time today, Wes.
Yeah, thanks for having me.